with the charts as we analyze the implications of approaching that low. We're going to zoom in one more time. We're going to go with a 2-month chart because the entry exit points we're going to be talking about will be included in this 2-month chart. I'm going to add the vantage point indicators kind of one at a time, explain them a little bit briefly, and talk about what you're looking at there. But then we're going to go to a combination of all those charts and try to explain to you how does that enter into making an entry decision. The first thing we're going to add is the predicted medium-term crossover. The predicted medium-term crossover is that blue line that you see there. The black line is the actual moving average, a simple moving average of the close, versus the predicted moving average, the blue line, of typical prices. You can see there where that trend, pretty much dictates the trend of the market. Several things about that will be important, but it's the blue line is an exponential moving average, black line a simple moving average, and the exponential moving average is a little shorter duration, but that is what has been determined by the computer to be the best combination for the medium-term time frame. We're going to add to that, we're going to add a couple of other indicators. The first is going to be the neural index. The neural index, that gray line that you see on the bottom, it has a couple of different readings that you can get out of that. The neural index basically compares two 3-day moving averages, a predicted moving average versus an actual moving average, and it tries to project, or it does project 2 days ahead what the price will be. If the price is projected to be higher, you will have a reading of 1. If the price is projected to be lower, you will have a reading of 0. So it's a fairly good short-term indicator what's going to happen, right out of the box with, with prices in the near term. I'm going to add one other thing to this to indicate a couple of things a little bit later. We'll make a bigger point of it later, but we're going to add a point here, and that is the predicted strength. That's the red line that goes across there. We'll talk about that in a little bit, but I'm going to add a couple more lines, hopefully not confusing you too much as to what we have here, but to try to explain to you how we put together these indicators. A couple of other indicators that we're going to add are the predicted differences. Predicted differences that you see on the bottom are the blue line and the green line. I know it's starting maybe to look a little bit like spaghetti, but if you'll follow through with this, we'll explain a little bit more about the significance of the predicted differences and indication of a potential turn in the market, an early alert of a potential turn in the market before it occurs, and when it is then confirmed by what happens with that predicted moving average crossing over or above or below the actual moving average. Now, there are a couple of things on here that we're going to kind of deal with, and there, as we follow through, as I say, you kind of got to follow through, through all the lines and kind of make a determination here, exactly which thing that you're going to be looking at and what's important, and we'll try to point out each of those as we go along. First of all, as I mentioned, we have the exponential moving average, that predicted moving average, the blue line. Now that blue line, as you can see in this case right here, the blue line moving up, pretty clear. It's a trend that is up, and the same thing when the trend goes down. Pretty clear indication of that. You don't probably need a whole lot of indication that the market is going up or down just on a visual case, but this provides a specific case where the crossover occurs and puts a little definitive number on that particular number. The second thing that we want to talk a little bit more is the predicted differences. As I mentioned, the predicted differences is the difference between a predicted moving average and an actual moving average. The blue line for a medium-term period, the green line for a long-term period. The key thing that you're looking at here, again, as an indicator that corroborates what's going on in the prices is, first of all, the angle of that particular predicted difference, if it's going up or down. Secondly, you're looking at the crossover situations to provide an early alert. Typically occurs several days before the market actually makes a turn. And because it acts as a momentum indicator, what it is kind of a converging, diverging situation with the moving average, the predicted versus the actual, and it picks up some underlying momentum that might not be quite so visible when you look at just simply the moving averages on the chart itself. Also, it's important to note this line right here is the zero line. If it is above, the predicted differences are above the zero line, you're talking about a strengthening situation or a market that is working its way up. It may not be as strong as it once was, but at least it's on working its way up. If it's below, it is weaker. A couple of other points to make about this predicted difference, or the neural index as it relates to that. You will see that there's a candle here where it looks like the market started to go down a little bit. Maybe it started to dip. But you'll notice that when we're talking about this strength, we're talking about a situation where the indicator reading itself, the actual gauge of that neural index, was barely down. So it's kind of one of those that maybe you can, kind of take with a grain of salt, kind of disregard it and look at that number as maybe not being a true indication of the neural index, that it might not be as likely to move down as that might suggest, as we mentioned earlier. Secondly, you'd also want to look at another point we're going to talk about, and that is where we had a situation up here where we had a market that was starting to turn down, make a little top, and you'll notice right here when we're talking about the strength of that neural index, it was, right here we had a neural index that still read 1.0, so in theory that's bullish, but when you look at the reading of it, how strong was that indicator? It was just barely above the zero line, and so that would have indicated just barely bullish. Now that factors into a couple of other things that we're going to be talking about, because we want to make sure that we have these indicators working together and be able to read everything that we possibly can. One of the things that I like to do also is to look at the typical types of things that traders are looking at, and what are they thinking about in terms of looking at. These are, I use a candlestick chart to do this. The first kind of clue that we had here that potentially we could be in a situation where this market might have turned was a situation where the market was at $10 or just above $10. That's a kind of important psychological level. How many times are you going to sell soybeans above $10? May not happen too often, but we had this combination occurring April 23rd, and we had kind of a little bearish candle, maybe even almost what might be called a harami. I'm not a candlestick expert on all these different types of candles. It's just kind of when you see them, you kind of know that you have a clue here that something might be taking place. The second one is the following day, the following trading day, April 26th, where you had a situation where you had, I think you would call that an evening star.